Okay, everybody, this is going to be lecture one. I'm going to call them lecture modules. This first one, we're going to look at just a kind of a course overview. And deal with some purpose, some facts. I want you to look at your syllabus carefully, which is basically the Start Here page at Blackboard. So the major topic we're looking at, as I put up in the intro, is financial planning and analysis, or you could call it analysis and planning. That's the first major area to look at. The second is capital budgeting. So this is financial managers dealing with long-term investment decisions. And we'll look at capital markets and risk and return on asset pricing. Several models exist for trying to price assets. We'll look at those that are used typically by managers. And we'll look at capital structure. This refers to the financing decision. Then we'll also deal with a little bit of working capital management if we get there. And working capital refers to current decisions or short-term decisions. Important to note, right, that really the course is pretty straightforward. It's dealing with, right, investment decisions. Right, what project do I want to invest in? And we're looking at financing decisions. How will I pay for these projects? Now, a third area, which we won't get to, but you should know about, is known as the dividend decision. I'm getting used to my writing pad here. The dividend decision. And the idea behind the dividend decision is, what do I do if I have money, right? I have money, and I got this money for a purpose, right? To take the money and put it into worthy projects. So these are the investment decisions. Where did I get the money, right? I obtained the money through financing, usually through equity. So I obtained money from owners, or persons would become owners, and of course I issue instruments of debt. Now, if I've got piles of cash and I can't find worthy projects, it might be that I need to return money to the owners. Now, what's really quite crucial, right, is that all of these decisions, right, all of the decisions that are being made in these different areas, they all impact the value of the firm. Right, so they all impact the value of the firm. Now, let's look at the balance sheet. Just briefly elaborating on the balance sheet equation. So the balance sheet equation should push us all the way back in our memories to a basic accounting course. That assets are equal to liabilities plus equity. Assets could be lined up in a T account format. And in finance, we generally think of the assets and liabilities in equity accounts based upon the market values. What you'll notice is that, of course, companies are utilizing accounting systems to generate the historical values. So, while it's true that we'll have a balance sheet for a company, and we've got this set up so that, right, assets are equal to, let's say, bonds and stocks. And then we have real assets. Those will be, right, equal to the paper assets, the financial assets. And the real assets are, right, they are tangible and they are intangible assets. So we're going to include both possibilities. And what's key is, right, that we need to know, right, the market value. That's really key for financial decisions. So why? Why would we be interested in the market prices, right? That's the kind of decision-making issue that complicates finance. To determine the understanding of asset prices, why assets have different prices, we need to understand how to measure risk, okay? Risk is key. See, the asset prices, right, they depend on risk. The risk of the project, is how we say, or the risk of the financial instrument. So all other things equal, the higher the risk, the lower the market value. Right? The higher the risk, the lower the market value. Right? Risk is up, market value is down, and of course, the exact opposite would be true also. That if you put a project in place that had low risk, the market value of that project would be higher. Okay, and remember, I did put a small caveat into that statement. All other things are equal, right? That's a complicating element. Just got to watch out for it. So what are these financing decisions, what do they look like? What kind of decisions are being made, right? So financial analysis and planning. Financial analysis and planning, the first major area we're going to look at, is to think about the firm by thinking about its strengths and weaknesses. That's the general idea behind the analysis work we're trying to do. Primary tool is the statement of cash flows. We want to look at cash flows. And we'll do financial ratio analysis. Try to figure out how those can be interpreted to tell us about the firm's strengths and weaknesses. We can also do trend analysis. Look at how the firm, how its strengths and weaknesses are changing across time. And we can do comparisons, right? You take the firm we're looking at that maybe we're managing and we do comparisons with other firms. Using the best available information and knowing our firm's goals and strategies, what we want to do is project the financial statements into the future. Right, the projection into the future gets us into the forecasting mode, the pro forma statements, which we could say is basically forecasting. How about capital budgeting? So we're running a firm, we have lots and lots of money. And what we want to do is examine what kinds of fixed assets we should put into the firm. What should we acquire to be fixed assets? These are left-hand side right, decisions, the asset side. Dealing with assets we should be putting into place. Now what's key here is, right, the assets that we put into place, these assets generate future cash. Now, to make a decision about capital budgeting, as well as any of the other basic financial decisions, we have to have the right kind of objective function in place for the manager. We want to know what objective the manager has. This is really key to the financing decision. Whether we're investing or borrowing or issuing common stock, we want to know what's our goal? What is it that the manager wants to accomplish? What we do is, from the objective, we'll obtain rules for the decisions that should be made. So we'll put into place the rules that the financial manager would want to follow. The capital budgeting decision requires estimating the future cash flows that asset has in place. We've got to learn how to estimate the cash flows of an asset. Once we've estimated them, we can put a value on them. We want to know, well, what would it be the case? What are we willing to pay to obtain this stream of cash flows, right? What are we willing to pay now, right, to generate future cash flows? This is the old adage, to make money, you have to have money. So let's look at what the value of an asset really is. So asset value, got to look at that as a key topic. Depends on the size of the future cash flows. Right, so the size of the flows, also the timing of the flows. At what point in the future do we receive this money? Whether it's coming soon or whether we have to wait 5 years is really crucial. And, right, the riskiness of the flows of cash. So now we know, right, the value is a function of, the F means a function of, it's a function of size of flows, right? The timing of the flows and the risk associated with those cash flows. So you could, how would you predict asset value when you're thinking about these three factors on a, say, of one-by-one or case-by-case basis? So a preliminary answer is to note that, right, this key idea is kind of rooted in common sense. Businesses, managers for the ages have, in an intuitive way, used some common sense to understand how it is that asset values are dependent on these factors. In a general sense, ceteris paribus, again, all else being equal, well, a preliminary answer would be an asset's more valuable, right? Value would rise, right? Value would be higher, V higher, right? If the future cash flows are higher. Future cash flows are higher. Also, if the cash flows come sooner than later, right? They're sooner than later. And also, if, again, everything else equal, if the future cash flows are less risky. Now, a much more precise answer to this comes through the course. And we're going to devote a lot of effort in assessing the factors here, and we'll get a sneak peek too. Now, what is the preoccupation of finance? The preoccupation of finance is, right, as you just discovered, cash flows. It's not the accounting numbers. It's not the earnings per share. See, cash is the lifeblood of the firm. It takes cash to pay the bills, to make investments, to pay off creditors, and distribute dividends. cash is key here. Everybody likes to have the cash. It's the way that the firm is able to operate. Now, the accounting numbers are valuable for making some decisions. And what we're going to do is gain some practice in determining and estimating cash flows. Now, once we determine what an asset is worth to the firm, we simply compare the value to what the asset costs. Right? So the asset value that we find, it depends on market behaviors, and those market behaviors influence, right, influence the size of the flows, when those flows occur, and the riskiness of those flows. The asset value, we might know that. Now we need to just make sure, and this is the key to operating a successful business, make sure the asset value exceeds the asset cost. So now what you basically know is that a course in corporate finance is what I like to call applied economics. It's applied economics. Anything that you do, we know from price theory, is that a manager should install a project when the benefits exceed the costs. So now we know the core idea is really rooted in basic economics. Now, what's going on is like when this setup or arrangement of value versus cost exists, right, then we know there's value creation going on. To know if you have a valuable project is quite complicated, however. If the asset is worth more than it costs, acquire the asset, right? Of course, if the asset is not achieving this result, we do not acquire. Right? If the asset is not properly valued, we're going to make a faulty decision. Now let's look at, say, capital markets. Why we need to know about capital markets. And risk versus return. So we get to discover why it is the case that risk and return has the specific relationship that it has. A key issue in finance is the study of risk. Now, how do we measure risk? We want to measure it. And once we understand how to measure it, the next question is to figure out how expected returns are related to risk. Now, what's key, a thing that's key here to watch out for, right, is that, right, measuring risk is difficult. And measuring the returns as they relate to risk, also difficult. So this is an area of the course you've got to be kind of careful with, right? Very crucial to be attentive. The next thing of note, right, would be to consider the issue of capital structure. Capital structure. This deals with the right-hand side of the T account. How the firm should structure its sources of financing. Right? This is what we call the financing decisions. These decisions, right, include, well, how much money should I borrow from a bank or from other lenders, right? How much to borrow? not just how much to borrow, but let's say whether I should borrow short term or maybe I should borrow long term. The general idea, oh yes, say, well, how much equity to issue. I want my firm to raise money perhaps from potential owners. How much equity to issue is really crucial. Now, the general goal when we sell these securities of debt and equity, we want them to be worth more to the buyer than their cost is to the firm. So once more, we've got to figure out the value of some securities and the costs associated. The basic idea is to blend what we call a portfolio of a debt together so that we push the cost down to the lowest possible cost and write this portfolio a collection of assets. Could be real or financial. Here we're thinking of the firm's right-hand side of the balance sheet as a portfolio of assets which supports a portfolio of assets listed on the asset side of the balance sheet. Now, from the point of view of the firm, these are liabilities to our owners and lenders. The persons who purchase those bonds from us, think of those as assets. So we think of the financial assets on the right side, the real assets on the left side of the balance sheet. But why would someone lend a firm money? Why would someone lend a firm money? It could be a bank, of course. It could be individuals. It could be investment houses. It could be venture capitalists. Why would someone hand money to a firm? The basic idea, of course, is the firm, it might be believed, will repay a loan plus adequate interest, right? Now, where does the money to repay the loan come from, right? It's generated from the revenues when we sell goods and services. The real assets generate goods and services, revenue comes, and we, as a result of making good operating decisions and having the right kind of employees in our firm with good talent, right? These are true assets, the employees. We generate cash and we pay people back, either in the form of dividends or in the form of interest. Now, why would an investor buy stock in the firm, right? The rational investor expects to realize some kind of return. Maybe they want to resell the stock later, or maybe they're going to get, future dividends. I think there's going to be future dividends. And that is, the owner generating some kind of, benefit from being a part owner in the firm. And they get to resell their security as well. Hopefully at a higher price than they bought it for. And the dividend decision is how the firm decides to get money to those shareholders, another part of the financing decision. So in essence, the firm is trying to raise money with retained earnings. That would be anything not granted in dividend form, by selling bonds, and by issuing stock. So the dividend decision is crucial, because it influences what level of money I have available from the earnings. Now, financial assets like loans and bonds, and of course you have a special class of stock. It's called preferred stock. And of course then, much more generally known as something called common stock. These types of securities are called contingent claims. They're contingent claims. Now, the reason why they're called this is because a financial asset derives its value from its claim on the cash flows generated by the real assets on the left side of the balance sheet. Right? So you have the balance sheet, and the contingent claims sit on the right side, over here in the liabilities and equity. And the real assets, right, are on the left side, and cash flows are coming from the use of the real assets. See, so the value of the firm is determined by its ability to generate with its real assets those cash flows. And that's, of course, dependent on the risks associated with those. Now, in Ross, Westerfield, and Jaffe, there's a diagram in the chapter that expresses the value of debt and equity as a function of the terminal value of a one-period firm. And in that context, right, a contingent claim is being described. So next, what we want to deal with, right, is working capital management. So working capital, short-term decisions. Now, a whole course is potentially viable when we want to think of this, but we're dealing with a subset of the investment and financing decisions. The idea of working capital management is taking current assets and current liabilities of the firm and managing those, right? How much cash should I have, right? Cash holdings in the firm. What kind of credit policies should the firm pursue? How much inventory would the firm maintain? These are current decisions. So the working capital management looks at the accounts payable balance, for instance. It's how much trade credit would the firm use? What kind of wage payment systems will it use? What kind of tax payments does it face, right? These are all part of working capital management. It's often the treasury function. Treasury managers are especially focused upon the working capital management decisions. Now, the net working capital idea that is key to examining the health of a firm. You've got to know this equation. Net working capital is the current assets minus the current liabilities. Net working capital, current assets minus current liabilities. Now, the larger the net working capital, the more the firm has to raise, we'll say, in terms of its long-term financing. You want to have that is a key idea to look at when you're considering a firm's health, right? The larger the net working capital, the more the firm has to raise in terms of long-term financing, especially bonds and stocks, right, to finance that balance. So more stocks and bonds needed, right, with higher net working capital. The next thing I've note we should deal with is the objectives, corporate finance objectives. It's key to highlight what's going on now. Managers are agents for the owners of the firm, right? The agents are making decisions for the principals of the firm. Right? Managers specialize in decision making. They specialize in decision making. They're hired by the owners to make good decisions. So you can think of the stockholders as principals, the owners of the firm. The stockholders, they specialize in risk bearing. right? Now, the stockholders are the residual owners. They get paid last. And it's time to pause. Okay, back again. Hopefully this is still recording. I had to step away briefly to deal with a child. So back in the corporate finance objectives issues here, principal agent issues arise, right? The shareholders own the firm, right? Without their equity capital, the firm could not exist. You really cannot borrow money without an equity base, right? So the managers have to work for the stockholders. Stockholders elect a board of directors, right? So you have the principals, the owners. You have the managers, right, who are agents. Agents. The managers are hired because of their specialization. The principals put into place, right, a board of directors. In an ideal world, the board is monitoring the managers. Managers have to be monitored. So managers who work for the stockholders and then elect, the shareholders elect the board of directors. The board of directors is really hiring, compensating, promoting, and sometimes firing managers. And given this discussion, then what should the managers be seeking? What's their objective? A long list is possible, but there are fatally flawed objectives. Businesses have pursued a wide range of objectives. The flawed objectives, I'm going to put these in red because this is a red flag. You could, for instance, try to maximize profits. The answer to that is not a good idea. See, it's not cash flow oriented. There's no time horizon, and there's no incorporation of risk in such an objective. Or we could try to maximize earnings per share. Also flawed for the same reasons as for maximizing profits. Or maybe we should maximize the size of a firm. Maybe, we're referring here to, right, the book value of the firm. Maximize maybe the size of assets. But size might not be in the shareholders' best interests because size does not equal value. It doesn't incorporate future cash flows. It doesn't incorporate risk. Maybe market share maximization. Some firms in the past have tried this. Market share, at what price, right? Are you going to attain your market share at the price of cash flows or risk? This also might not be in the shareholders' best interests. How about compensation maximization? Where the shareholders are allowing their managers to maximize their compensation, this is clearly not in their best interests. What we're going to choose for our appropriate objective function, the appropriate objective function, which one should it be? It can't be the previous functions. Rather, what we're going to use for our appropriate function, right, is shareholder wealth maximization. The managers, thus, will attempt to maximize the wealth of the owners. You should be able to discuss this and defend this or refute this. Let's think about maximizing shareholder wealth a little bit. What does this mean? It's share price maximization in a general sense. Shareholders are the owners of the firm. Now, is shareholder wealth maximization, what the shareholders want the managers to do? And the answer is yes. So the first answer is right. This fits logically with the owner's preferences. If managers make decisions that maximize shareholder wealth, shareholders can then make their own optimal investment and consumption decisions. They could choose to give to charities, and they'd have the ability to make a greater impact as a result. Is shareholder wealth maximization, is it socially irresponsible? The answer is a resounding no. It is not irresponsible. What do you think would happen to share price? What happens to the share price? Some firm is being run by managers. What happens to that firm's value, right? If managers, right, engage in some suspicious and irresponsible behavior. Suppose they were to rip off employees or suppliers or, say, customers, the government. Suppose they were to rip off society. See, in the long run, the shareholder wealth maximization has to consider these other stakeholders that are participants in the firm's actions. The results of the firm's actions are going to influence all of these stakeholders. The issue is, right, that if the managers engage in corporate rip-offs of the stakeholders, the share price is going to suffer. Future cash flows and risk will be damaged if the firm is not run by a responsible citizen. Now, this argument assumes that the markets are well functioning, and that might not be the case, right? Not all markets everywhere are perfect. Well-functioning markets, that's an appeal back to economics, and we know that there are market failures, that market failures can exist. A clear example is pollution. So, right, society, the environment, right, is crucial to examine. Now, what would we do finally if we were looking at this model of the firm? In light of what we call the principal agent setup, we should be aware of agency problems. The normal or theoretical appropriate objective function is to maximize shareholder wealth. In the real world, do they strive for that objective? Could they be concerned with just themselves instead of the shareholders? See, there can be conflicts of interests between managers and owners. This is just something that arises naturally. This, of course, we'd be kidding ourselves, right, if we didn't think this was true. If you left the managers to themselves, they would probably act to try to maximize their self-interests. The existence of the conflicts of interest actually creates a very large stream of literature in finance under an area of thought called agency theory. Sources of conflict have been identified. Sources of conflict include, say, managers and what effort levels they decide. And what kind of risk aversion levels do the managers have? Oftentimes, managers are quite risk averse, and that goes against most shareholder interests. They might have different time horizons. Managers might be very short term, where the shareholders want to be long term. And there's a tendency among managers to over retain funds. When really, the owners would prefer to have the cash. So, how do we resolve these conflicts? How do we do that? How do we resolve them? You have, of course, market control mechanisms. Classic market control is, right, getting the management ousted when a hostile takeover takes place. You also have the managerial labor market. Right, good managers are going to make more money and see reputation is valuable. And of course, you have the product markets. Product markets. The inefficient firms are going to go out of business. Also, internal monitoring. So the firm will have control systems in place. Firms also have contracts, and they have to abide by contracts with their suppliers of capital, with their customers, with corporate charters, compensation contracts for management, and so on. And we have outside monitoring. The SEC, for instance, and outside auditors, right? And shareholders, right, can also engage in lawsuits. It's class actions, for instance. You also have monitoring by the right outsiders, call it outside large shareholders. Often these are institutions. It might be a pension fund, for instance, and they have a very large equity position. Now, it's not a perfect assumption, but we're going to assume that managers make decisions that maximize shareholder value. Under that assumption, we can formulate decision rules for the managers to follow. The whole course assumes this objective. If we disagree and don't believe it, the whole course is not going to make sense. Okay? It's an important benchmark. It helps you establish rules of the game. Before you can know anything about how much a conflict of interest costs, you need to know what would the performance look like if the conflict didn't exist. Right? So the firm has value when there's conflicts. So you have what call it conflict value. And the firm has an ideal value, which would be higher if the conflicts didn't exist. So now you get a sense of an understanding of how managers should keep their jobs or not. Those that perform poorly, for instance, would generate perhaps resulting share prices falling. Shareholders are unhappy. Managers are more likely to get fired. The firm's taken over in a hostile takeover, and then a better management team is put in place. That's all kind of governing under the market control mechanism idea. So in the course, we'll assume that disciplinary mechanisms are all keeping managers on their toes. Now, if you take legal and professional ethics and a few other courses, you get a little more sense of some of this, right? Now, sneak preview. When you look at the discussion, the major decisions the firm was facing, we danced around a little bit of a goal, which was how do you value an asset? And students usually ask a lot fewer questions about hey, why we're doing this, if you can see a particular goal kind of written down, put in place really clearly, and here the general idea behind the value of the asset and the cash flows is much more clear. I'll get cash in time period 0, let's say. Often that's a cash outflow. I'll get cash in time period number 1, time period number 1. And that flow of cash has to be discounted by 1 plus r. I'll get cash, say, in time period 2, and we'll learn that we should discount that by 1 plus r squared. And that can continue for as long as the cash flows occur in the firm. See, the C's here are future expected cash flows. Future expected cash flows. Let's make it green for cash, right? They're happening in the future. They are predicted. They're expected, right? They're cash flows. The R, that little r, right, is what we call the discount rate. It's defined as the discount rate. And V just means value. And this is called the discounted cash flow valuation formula. You might have seen this before, perhaps in an undergraduate course. The equation basically says that if you're going to value a firm or an asset, you need some kind of forecast of the future cash flows generated by the owners of that firm or of that asset, an understanding of when those flows are coming. And you need some idea of an appropriate discount rate. The appropriate discount rate, that depends on the riskiness of the asset or the company. The riskiness. What we'll do is deal with, first off, how you develop forecasts of cash flows, which are the numerators in the expression. Now, as you move through various topics of corporate finance, you'll see how finance interacts with other functional areas, such as accounting and marketing, production and operations management, and human resource management, research and development, and so on. See, so the financial managers have to be versed in basics of accounting and marketing, and the other functional area managers should understand the basics of finance. Maybe you aspire to own your own business. Maybe you're an entrepreneur. You have to have a basic understanding of financial management. It's absolutely indispensable. Data shows that poor financial management is the leading cause of firm failure. Now, the subject is not an easy one. You're going to need to spend a bit of extra time studying. Just like you would have to spend extra time to be a successful lawyer by studying more intensely, to master the basics of finance requires a bit of effort. You might discover, though, that understanding financial principles will greatly benefit you in your personal life. Say, when you go to make a major purchase, when you design your investment portfolio, let's say plan for your retirement. Correct application of a little knowledge can really go quite a long way. So, it's not easy, but it's very useful. Of course, it's critical for running a firm properly. It's crucial for firm survival. It might have personal. And oftentimes, I have my typical student who decides that the personal side of things right off is much more helpful. And then later, when they're a little more advanced in their career, they begin to see how some of the the insights of basic finance are really being used and applied in their business environments. Because they don't tend to become financial managers as a kind of a career track, but you begin to slowly awaken to the cruciality of the decisions for your ability to actually have a job and so on. So that sets up for us an initial lecture. I'm going to put this on Blackboard, and we'll be ready to go for the week.